The IRS changed the rules on your retirement account on January 1st of this year. Not a rumor, not a proposal, done. And the specific people it targets are exactly the ones who spent their careers doing everything right, maxing contributions, earning above average, trying to catch up before retirement. 3 changes, layered on top of each other, quietly. And by the time most people notice, the tax bill is already written. The Social Security Trust Fund is now projected by the Congressional Budget Office to run dry by 2032, not 2040, not sometime in the future, 6 years. At the point of depletion, continuing program income would be sufficient to pay 77% of total scheduled benefits, a 23% across-the-board reduction for every beneficiary, regardless of need or contribution history. Nationwide, the average 401k balance was $148,153, compared with a median of $38,176. The magic number Americans think they need to retire comfortably in 2026 is $1.46 million. That gap is not a rounding error. That is a different planet. And here is the thing that ties all 3 of those facts together into one coherent picture. The government didn't accidentally create a situation where Americans are undersaved, Social Security is underfunded, and retirement account rules keep shifting. Those things are connected. The incentive structure explains everything. And that's what we're going to walk through today. Here's the thing. When you saw this title, you probably thought I meant something dramatic. A seizure, a confiscation, some emergency government bill to nationalize retirement accounts. That's not this. What actually happened is quieter and more damaging than that, because the government doesn't need to take your 401k. They already own a percentage of it. They've owned it since day one. And starting this year, they are restructuring when and how they collect, and on whom, and in what order. What I am going to do is walk you through 3 mechanisms through which money is being redirected out of your retirement strategy. One changed this January, one is 6 years away and already priced in by the Congressional Budget Office, and one has been running silently in the background for decades. Then I'm going to give you a specific framework for how to respond to all 3. Not theory, actual numbers, actual dates. I have multiple hundreds of thousands of dollars invested. I've spent over a decade running my own business, surrounded by accountants and fiscal lawyers who explain to me how money actually moves through these systems. When I tell you the game is different than the brochure, that's not cynicism for its own sake. That's the reading of the actual legislation. Imagine you and a business partner open a restaurant. Your partner provides the permits, the legal structure, the tax treatment. You provide the labor, the savings, the daily grind. You agree to split the profits eventually when you're ready to cash out, but your partner gets to decide the payout terms. And those terms can be renegotiated with notice, technically at any point. That's your 401k. You put the money in, you carry the market risk, you surrender liquidity for decades. And in exchange, your silent partner, the federal government, lets you defer what you owe them until later. Call it what it is, a tax delay, not a tax break. Every single dollar in your traditional 401k has a liability attached to it. A future invoice denominated in whatever tax rates happen to exist when you pull the money out. The account balance you see on your statement, that's not your money. That's your money minus an invoice you haven't paid yet. Your 401k is a tax IOU. I'm going to use that phrase all the way through this video because it's the most accurate framing I know. And this year, the government started calling part of that IOU in early for specific people in a specific dollar amount for a specific reason. In a few minutes, I'm going to show you exactly how the Social Security math breaks this entire game open and explains why these changes are accelerating. But first, you need to understand what went live on January 1st, 2026, because it's more targeted than the headline suggested. The Secure 2.0 Act was passed by Congress in late 2022. It was 858 pages long. Most people heard about the part where required minimum distribution ages went up. But buried deep inside that legislation was a provision that was originally supposed to take effect January 1st, 2024. The provision was originally mandated to become active on January 1st, 2024. But given the lack of time for payroll providers, administrators, and record keepers, employers and employees to adequately prepare, the IRS announced a delay. The legislation took effect on January 1st, 2026. If you're 50 or older and your FICA taxable earnings are $150,000 or more, any catch-up contributions to your 401k now have to be made to a Roth 401k with after-tax dollars. Think about what that actually means. High earners will no longer get an immediate tax break from pre-tax 401k catch-up contributions. Their taxable income will be higher, and that can lead to a higher effective tax rate. Here's the math. In 2026, the standard deferral limit is $24,500, with a catch-up contribution of $8,000 for those 50 and older. If you're in the 24% federal tax bracket, that $8,000 pre-tax deduction was saving you $1,920 in federal taxes per year. That deduction is now gone. You're paying taxes on that $8,000 in the current year at your current rate, rather than potentially in retirement at a lower rate. Now you're asking yourself, well, Roth money grows tax-free, so isn't this just a different timing? Yes and no. The pre-tax strategy worked because you expected to be in a lower bracket in retirement. If you're 53, pulling $200,000 in taxable income right now, and you plan to live on $70,000 a year in retirement, the math favored pre-tax. The government just removed that choice. If your employer's retirement plan doesn't offer a Roth option, you will lose the ability to make catch-up contributions altogether. Completely. Not reduced. Not delayed. Beginning in 2026, certain higher income participants can only make catch-up contributions on a Roth basis. Plans that do not offer Roth contributions will be unable to accept catch-up contributions for those participants. The rule change is permanent, and it is based on the prior year W-2 form from the employer sponsoring the plan, which means if you earned $150,000 or more for tax year 2025, the change applies to you for the 2026 tax year. Here is the second layer of damage, and it's the one that's easier to miss. Many small and mid-sized employer plans still hadn't added a Roth feature as of January 1st. For most plans, that amendment must be adopted by December 31st, 2026, which means there are people right now, in the middle of this tax year, who went to make their catch-up contribution and found out their plan infrastructure didn't support it. Their catch-up limit? 0. Why did Congress do this? Because the Tax IOU needed to be restructured. When you contribute pre-tax to a 401k, the government gets paid later in 20 or 30 years when you're drawing down in retirement. When you make Roth contributions, the government gets paid right now, this fiscal year, at whatever tax rate applies to your income today. Congress pulled forward tax revenue from millions of high earners simultaneously, for a very specific reason that I'll get to in the next section. When Congress passed the Secure 2.0 Act in late 2022, many of the headlines focused on immediate retirement plan enhancements. Less attention was given to provisions that were intentionally delayed. The revenue-generating mechanisms don't get press releases. They get buried in subsection B3IA of something. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now let me show you what's driving all of this. Because the Roth catch-up mandate doesn't exist in a vacuum. It exists because the government's other major retirement commitment, Social Security, is running out of money faster than expected. There's a man I'll call Raymond. Retired in 2022 at 65. Did everything right. Built a $450,000 401k over a 30-year career. Paid off his house. Built a plan around $60,000 a year and spending some from his account and his Social Security check of about $2,000 a month. Solid plan. Standard assumptions, what Raymond didn't model is what that Social Security check becomes in 2032. In its February 2026 budget and economic outlook, the Congressional Budget Office projected that the Old Age and Survivors Insurance Trust Fund will be exhausted by fiscal year 2032. That projection is a full year earlier than the 2025 Social Security Trustees Report, which had set the depletion date at 2033. The average Social Security retirement benefit as of April 2026 was $2,081 per month. A 23% reduction would cut that by roughly $479 per month. That's nearly $5,748 a year. Raymond didn't plan on losing over a 20-year retirement. $114,960. And that's if he retires at the right time and claims correctly. Raymond's retirement math is already broken, and he doesn't know it yet. Three forces pushed the depletion date forward. The Social Security Fairness Act added more than $17 billion in retroactive payments, accelerating outflows. The One Big Beautiful Bill reduced payroll tax revenue flowing into the system. And the demographic math keeps grinding forward. Roughly 10,000 baby boomers turn 65 every day, expanding the beneficiary rolls faster than the worker base can support. Policymakers have known for decades that Social Security's finances are unsustainable, but have consistently failed to act, leaving the program an estimated $25 trillion short over the next 75 years. 25 trillion with a T. And Congress's response has not been a structural fix. It has been incremental restructuring of retirement accounts, including the Roth catch-up mandate that pulls forward tax revenue without anyone calling it a Social Security solution. The government is solving its fiscal problem using your retirement account, not by confiscating it, by changing when it collects. This is the reversal. You think Social Security is the problem. Actually, the 401k is the backstop they're quietly repricing. The tax IOU you hold is being called in earlier because the government's own balance sheet is tightening. The Social Security Administration started tapping into the trust fund reserves in 2021, when the total cost to provide benefits started to outpace the agency's income. That was 4 years ago. Since then, two major acts of Congress expanded benefit payouts or reduced incoming revenue. And now the CBO is publishing reports with headings that say, essentially, we have less time than we thought. Stay with me, because this next part changes everything about how you should think about the money that's already inside your account. Knowing these numbers and actually building a system around them are two completely different things. Because right now you have a Roth catch-up rule that costs high earners up to $1,920 a year in immediate federal tax burden. You have a Social Security reduction on the horizon that potentially eliminates nearly $6,000 a year from the income most retirement plans depend on. And you have a fee structure inside most employer plans that most people have never looked at, which I'm about to explain. All of that belongs in a single model. Your typical financial advisor charges 1% of your assets per year to explain half of it while selling you products that serve their compensation structure. I spent the past year building something I call the Exit Code, a digital book built on 50 years of actual retirement data, distilled into a mathematical framework for identifying when and how you can actually exit the rat race. This isn't a vague retirement calculator. It covers the dynamic withdrawal method, the sequence that replaces the 4% rule for people who need their money to survive a bad market in year 1 of retirement, not just year 20. It covers the 58% rule, the buffer calculation for a forced early exit, because the data shows more than half of early retirees don't leave on their own terms. And it goes deep on what I call the $14,000 invisible bill, the healthcare cost gap that ambushes retirees under 65 who didn't model the bridge between employer coverage and Medicare. 8 chapters, 50 years of data, no filler. You can get it through the link in the description for less than the cost of 1 hour with a mediocre financial advisor. Every year you don't have this framework is a year the compounding math is working against your plan, not for it. Now, let me give you the third mechanism, the one that's been running silently inside your account since the day you opened it. There's a short story I want to tell. In the 90s, a mutual fund manager ran a large cap growth fund that performed respectably. His annual expense ratio was 1.2%. Not unusual for the time. His clients received quarterly statements showing positive returns. They assumed the fee was the cost of getting those returns. They didn't think about it further. Worker A invests $100,000 with 0.5% in fees. After 30 years at a 7% return, the account grows to about $574,000. Worker B invests the same amount but pays 1.5% in fees. After 30 years, the account grows to only about $432,000. That is a $142,000 difference funds, lost entirely to fees. That's not a worst case scenario. That's a typical gap between a high-cost actively managed fund and a low-cost index fund inside the same employer plan. Over a lifetime, fees can cost a median income two-earner family nearly $155,000 and consume nearly one-third of their investment returns. Though your retirement account statements contain no evidence of it, everyone who has a 401k pays a variety of fees every year. Because these fees are taken off the top of investment returns or share prices, account holders generally have no idea how much all of this is costing them. This is the structural beauty of a fee that's expressed as a percentage of assets. It doesn't appear on your statement as a line item called fee withdrawn. It reduces the reported growth rate. You see the net return. The gross return, what the market actually did before the fund company took their piece, is never displayed. You feel neutral about an account growing at 6.3% without knowing that the underlying index returned 7.5. The difference is invisible, compounding quietly against you year after year. The tax IOU framing works here too, but with a different counterparty. The government collects at withdrawal. The fund companies collect now, every year. Whether you're up or down, your 401k has at least two silent partners, and only one of them waits until you cash out. Many people never check what they're paying. They assume the employer handles everything. By law, employers must provide a document, a 404, a 5 notice, that lists fees in detail. Most people have never read it. Most people don't know it exists. Now, let me introduce you to Dave. I've been building toward Dave for a while. Dave is 52 years old. He earns $180,000 in FICA wages. He's been maxing his 401k every year since 48. His current balance is $380,000, almost entirely in his traditional pre-tax account. He has not read his plan documents in 3 years. He's a smart, diligent person who trusts the system. Dave doesn't know that his plan administrator quietly added a Roth feature in January 2026 to comply with Secure 2.0. What Dave also doesn't know is that his payroll system automatically started routing his $8,000 catch-up contribution into the Roth side. His pre-tax deferral is the same $24,500, but that $8,000 catch-up is now after tax. His taxable income is $8,000 higher than he expected this year. At his rate, that's approximately $1,920 in additional federal taxes he wasn't budgeting for. Dave's wife calls this an accountant problem. Dave's accountant will discover it in April when they're doing his taxes. By then, the money has already moved. But here's the deeper version of Dave's problem. Dave's $380,000 is almost entirely in the traditional pre-tax bucket. Every dollar he pulls out in retirement is taxed as ordinary income, not capital gains rates, ordinary income. If Dave retires at 65 and pulls $60,000 a year from his 401k, and his Social Security is $2,081 a month in current dollars, that's roughly a combined income of around $85,000 annually. That puts him in the 22% bracket. Fine, mostly. But here's the problem he hasn't modeled. At the point of OASI trust fund depletion, continuing program income would be sufficient to pay 77% of total scheduled benefits. Dave's $2,081 Social Security check becomes $1,624. He now needs to pull more from his 401k to maintain his lifestyle, say an extra $5,000 a year. That additional income pushes him further into the 22% bracket. It may also push him above the IRMAA Medicare premium surcharge threshold, adding potentially $69 to several $100 per month to his Medicare costs. Dave built a retirement projection. What he built was a pre-tax liability wrapped in an optimistic assumption. The account balance and the spendable income are two completely different numbers, separated by a tax structure he has never fully modeled. Now, you think the problem is not having enough money. Actually, the problem is that the balance you see on your statement is not the amount you'll be able to spend. It's that balance, minus whatever the government charges you to access it, minus the compounding cost of fees over 30 years, minus the Social Security reduction that is now in the CBO's written projections, minus any healthcare bridge costs between employer coverage and Medicare. The 4% rule, the idea that you can safely withdraw 4% of your portfolio annually and have money last 30 years, was established in research from 1994 by a financial planner named William Bengen, calibrated on historical returns in a specific interest rate environment. It doesn't account for tax drag on every traditional 401k withdrawal. It doesn't account for the sequence of returns you actually experience in year 1 or 2 of retirement. To generate $50,000 per year from a portfolio under the 4% rule, you need $1.25 million. To generate $40,000, you need $1 million. Those numbers don't include your tax liability on the withdrawals. They don't include a 23% Social Security haircut. If your plan for retirement is built on a rule calibrated in 1994 that doesn't include your actual tax rate, your insurance gap, or benefit reduction the CBO put in writing this February, that plan is fictional. The inputs are wrong. The output is confidently wrong. Your financial advisor's favorite phrase is, historically, markets return 8%. Historically, your office didn't have a Keurig machine and you could smoke at your desk. Environments change. The 4% rule is a reasonable starting point. It is a terrible ending point. Let me give you a concrete scenario. Mark is 45. He earns $95,000 a year. He's been contributing 6% of his salary to a 401k for 12 years with a 3% employer match. His current balance is about $162,000. His plan's average expense ratio is 1.1%. He plans to retire at 65. Over the next 20 years, assuming 7% gross annual returns, Mark's account at 1.1% in fees grows to approximately $610,000. If Mark shifted to low-cost index funds available inside his current plan, or if he left his employer and rolled into a solo 401k at 0.2%, his balance at 65 is approximately $755,000. That is $145,000 additional dollars that required zero additional contribution, zero change in investment strategy, and zero additional work. It required one action, reading the 404A5 notice and choosing a different fund. The Social Security COLA for 2026 was 2.8%. Mark at 65 will receive roughly $2,000 per month in current dollars from Social Security based on his earnings history. Under the projected 2032 depletion scenario, that becomes roughly 77% of scheduled benefits. Call it $1,540 per month instead of $2,000. Over a 20-year retirement, that lost 23% represents approximately $110,760 in income Mark had assumed was guaranteed in his projection. Approximately 28% of Americans have no retirement savings at all. Among those under 35, about 42% report zero retirement savings. Mark is ahead of the average. And Mark still has gaps in his model that total well over $250,000. That's not a scare tactic. That's the output of running the actual numbers rather than the brochure numbers. The phrase tax advantaged account was clearly written by someone who wanted you to focus on the advantaged and not ask who holds the other side of that advantage. Let's come back to where we started. The IRS changed the rules on your retirement account this January. The CBO projected the Social Security OAC Trust Fund will be exhausted by fiscal year 2032. The median 401k balance nationally was $38,176. Those are not three separate news stories. They are three angles on the same structural reality. The government's retirement commitment is underfunded. The tools available to pull forward revenue are your retirement accounts, and the people who lose in that arrangement are the ones who never read the actual rules. The silent partner in the restaurant is managing a cash flow problem, and the restaurant employees aren't being told about it. Here are three specific things, not generic, not vague, calibrated to what we just discussed. First, if you are 50 or older and your FICA wages were above $150,000 last year, Verify this week, not this month, this week, how your catch-up contributions are being classified. Call HR, call the plan administrator. The rule is permanent and based on your prior year W-2 from the employer sponsoring the plan. Your payroll system may have silently moved those contributions to Roth in January. That changes your current year taxable income. That affects what you owe when you file. You need to know before April. Second, request your plan's 40405 fee disclosure. This is a legal document your employer is required to provide. Find the total expense ratio for the funds you actually hold in your account right now. If you are in actively managed funds at 1% or higher, and your plan offers index funds at 0.1 or 0.2%, the difference compounds against your balance at a rate that produces six-figure losses over a 20-year horizon. This is not a complex calculation. It is a number comparison. The fact that most people never do it is precisely what makes it expensive. Third, run your retirement income projection twice. First, with your current Social Security estimate at full benefit. Then with that number reduced by 23%, using the CBO's own published depletion scenario for 2032. Various estimates suggest around a 20 to 25% benefits cut would be necessary at depletion, which for the typical retiree receiving about $2,000 per month would mean a drop of around $400 to $500 per month. If the second version of your projection creates a shortfall, meaning your plan depends on Social Security working at full capacity, that plan has fragile assumptions. The buffer you build now, through Roth contributions, additional taxable accounts, or a different withdrawal sequence, is not pessimism, it is accuracy. It is treating a CBO forecast with the same seriousness you'd treat a weather forecast before you fly. Dave, from earlier in this video, is going to be fine. Not because the system is fine, because Dave is going to watch this video and actually make those 3 phone calls. The people who lose in this are the ones who heard the same information and filed it under will deal with that later. Later is when the bill arrives. The math doesn't care about your intention to deal with it. Lazy investing built more fortune than crypto memes. The 401k is still a good deal, given the employer match, the compounding runway, and the tax deferral. The problem has never been the account. The problem is the gap between the number on your statement and the number you'll actually be able to spend quietly engineered through fees, tax liabilities, and policy decisions made in rooms you were never invited into. The people who understand the actual terms of the deal are the ones who end up with the money.